All right. So today, what we're going to be going through is a presentation, okay, on basically the Basically, we're going to be going through a presentation on Section 469, which is the passive activity rules, which limit you from taking losses from your rentals against your active real estate, and how the short-term rental loophole can save you 5 to 6 figures in taxes and help you get around that. All right. So I'm not going to be able to answer too many questions here tonight. But I will have future live events where I will be more interactive. Today, I'm just going to go through the presentation. Again, apologies for the technical difficulties. So what we're going to be going through here tonight is a brief history and overview of the passive activity rules that are found under Section 469. We're going to be going through the ways around these passive activity rules, and especially how the short-term rental loophole allows you to bypass these rules and use the losses from your short-term rentals against your W-2 and other active or non-passive income to save 5 to 6 figures in taxes. And at the end, I am going to discuss a little bit about our short-term rental course that we did create. And that does break down everything you need to know about the short-term rental loophole. Everything you need to know is broken down in that course. And I'm going to have a special offer for everybody who stays on till the end that you're not going to be able to get pretty much anywhere else at this point in time. So with all that being said, we're just going to go ahead and jump right in. Okay. So before we begin, why should you even care about the passive activity rules, right? Why is this Section 469? Why does this even matter to you? Well, the answer to that question is because all business activities are either considered passive or non-passive, okay? And passive activities come with certain rules, especially passive activities are rental activity. All rental activities, as we'll learn tonight, are passive by default. And passive activities come with certain rules that limit your ability to deduct losses, especially if it's rental real estate. All right. And the reality is we do not want these losses to be limited. We do not want these losses to be limited because of the time value of money. And the time value of money states that $1 today is worth more today. $1 today is worth more than $1 tomorrow. And that's partially due to inflation. And we all know that inflation is surging this year. We just got the June report. It was up 9.1%, which is the highest inflation's ever been since 1982, which is nearly 40 years ago, right? So that's part of it, but that's only part of the equation. The other part is that if you have $1 today, you can invest that $1 and earn a return on your money. And just to kind of give you an example of how this would work, let's say you had $10,000 that you had to write a check to the IRS, right? Well, now that money is gone, poof, it's gone forever. And who knows when you'll ever get that back? You probably won't. But you know what? If you're able to use a strategy like the short-term rental loophole, for example, to offset your taxes, what that's going to allow you to do is that could allow you to take that $10,000, invest it today. And let's just say you invested that $10,000 at an 8% return, which is really quite conservative for real estate in general. And it's even more conservative when you're talking about short-term rentals. But let's just say it's 8% for the sake of argument. In 10 years, if that 8% compounded every year, you're going to be left with $21,500, right? So that's $11,500 of wealth that you did not have before. Okay. It's that because you paid the IRS at $10,000, you would never been able to generate that $11,500. And let's just say that these numbers get a little bit bigger. Let's say you were able to save $100,000 in taxes. And now you're going to have $215,000 in 10 years. And that's $115,000 that you didn't have before. So that's the power of the time value of money. And that's what makes investing so powerful. And the reason why we want our losses to be non-passive is so that we can take that tax savings and reinvest it and keep our wealth growing. And the good news is there's some ways around these passive activity rules, and that's what we're going to discuss tonight. All right, so I want to give a quick breakdown and a quick overview of how these passive activity rules came into play, because it's helpful to understand why we even have to jump through all these loopholes to take our losses from our rental properties in the first place. Okay. So basically, Section 469, known as the passive activity rules that made all rental activities passive, was passed under the Tax Reform Act of 1986 under the Reagan administration. And before 1986, you were able to just buy a rental property. So you go and buy a rental property, could be a long-term, could have been a short-term, even though they weren't really as popular back then. But nonetheless, you bought a rental property and they were able to use the losses from the rental property that are generated from depreciation against your active income or pretty much any source of income, no questions asked. It was a free-for-all. And what ended up happening was there's a lot of highly compensated individuals, specifically physicians, lawyers, sales representatives, people, a lot of different people who earned a lot of income were just buying up these properties and using the losses to offset their income. And they were doing this with real estate and other tax shelters. And really, it became really controversial. So what Congress did, Congress ended up saying, you know what, we can't have this. We're gonna throw a patch on this, and they implemented Section 469. And Section 469 made all rental activities passive by default, and it added some other things in for businesses as well that can make businesses passive. We'll talk about that too in a little bit. But so for 8 years, from 1986 to 1994, all rentals were passive, period, end of story. No, there was no exceptions, right? Or if there were, they were limited. But what ended up happening was the real estate industry, agents, brokers, developers, people in construction, et cetera, property managers started to get really angry and said, you know what, this really isn't fair, right? We're in the business of real estate full-time. We're in the business full-time. Why is it okay for a physician or a dentist to go buy an x-ray machine and go ahead and use the depreciation from the x-ray machine against their income, but we're in real estate full-time and we can't use the losses from our rental properties against our real estate income? So through a lot of lobbying in Congress, what ended up happening is Section 469C7 was put into place in 1994, and that's what's known as the real estate professional status. Okay, and the real estate professional status allows people to take losses from their rental activities against their active income if they work full-time in real estate, basically. And we'll get into that in more details as well. But just know that Section 469 was born in 1986 under the Tax Reform Act of 1986. So if you were born before then, or you were able to invest in real estate, you're able to take advantage of that, great. I wish I could have done that, but I couldn't. All right. And what Section 469 says, well, let's back this up. What is a passive activity? And Section 469 defines a passive activity as all rental activities, period, end of story, are passive, unless you use an exception, which we're going to break down tonight, like the real estate professional status or the short-term rental loophole. They also said that any trade or business in which the taxpayer does not materially participate. So if you're not materially participating in a trade or business, it can be passive as well, believe it or not. And that's true. The best example I can give of that is, say your friend goes and opens up a pizzeria, or goes and opens up a car wash, or goes and opens up any type of business. They form a partnership and you go ahead and you invest with them. Well, guess what happens? The losses, because you just put up the money and you're not materially participating, your losses, your income or loss from that business is going to be passive. Okay. So this is where the short-term rental loophole comes into play. As we'll learn in a second, the short-term rental loophole basically allows your short-term rental property to become a trader business. And trader businesses are not passive by default, like rental activities. Okay. And something else I want to highlight here, as far as the tax code is concerned, when we're talking about Section 469 and passive and non-passive losses, all income is either passive or non-passive. There's only two buckets, right? So people always say, you know, well, I invested in Amazon stock or Tesla, or I'm receiving dividends from 3M or whatever. That should be passive, right? You know, I invested in Amazon, it shot to the moon, and I didn't do anything. You know, the people at Amazon did it. Jeff Bezos and the entire staff at Amazon did that. Well, unfortunately, the tax code doesn't really work like that. That's considered portfolio income, which falls into the non-passive bucket. And by the way, if you want to learn more about the passive activity rules, go to this website, the Cornell website, or just Google it, and you'll be able to learn. You'll be able to pull up the tax code, learn for yourself. Okay. So why are rental activities passive? Well, as we discussed before, Congress's intent with Section 469 was to reduce the ability to invest in real estate and use it as a tax shelter. Remember, all these highly compensated individuals were buying up all these properties, doing very little to no work on them, and basically just taking massive losses against their income. And it just became very controversial. So they decided that, we're going to get rid of them. And another thing to mention too is rentals actually generate tax losses even when they're profitable. So I don't know if, I don't know if everybody on this presentation knows about depreciation. So I'll break it down real quick. This is the power of depreciation. And this is one of the most powerful. This is why real estate is one of the best investments to begin with, right? It was so tax advantaged. Because let's just say you had $10,000 of rental income, right? $10,000 of rental income. Now you have $5,000 of hard expenses, right? We're talking about repairs, maintenance, utilities, property taxes, etc. So these are expenses that left your pocket. Well, now you'd be left with $5,000. And in an ordinary business, this would be considered $5,000 net income, taxable income. So you'd be taxed on that $5,000. Well, real estate, because it's so expensive, it's so capital intensive, there's this expense called depreciation, which is non-cash. What that means is it does not take cash out of your pocket, but it reduces your taxable income. So let's go back to our example. We had $10,000 rental income, $5,000 of legitimate expenses that have to go to pay someone to basically pay for the property, right? And now let's just say you have a $6,000 depreciation expense, right? Okay, well, depreciation is non-cash. So for your taxable income, you now have a loss of $1,000, right? So now you have a loss of $1,000. So what that means is, you do not pay tax on your rental income. And again, this is why it's so powerful, because you just generated $5,000 in cash flow that you could put in your pocket and do whatever you want with. But for tax purposes, you have a negative $1,000 loss. Pretty good because you didn't pay any taxes. But now the question is, what happens to that loss? And in many cases, you're going to have a loss in excess of $1,000 for real estate. This is just an example. So the question is, what happens to that loss? Well, under Section 469, that loss is passive and cannot offset your active income. It will be suspended and carried forward into the future until you have passive income from your rental activities or passive income from another activity that you might have. And again, we don't want this loss to be passive. So here are the ways that you can get around the short-term rental loophole. So one is when you sell the property in what's known as a entire disposition or a substantial disposition, meaning you basically sold the property, the losses from that property are unlocked. And when they're unlocked, they're going to offset the capital gain on sale, any other passive income you have for the year. And then if there's any loss remaining, it can offset your W-2 or other non-passive income. The problem is with number one, this first option here, is that the way the markets ran up over the last 10 years or so, this very rarely, if ever, I haven't seen it too often, honestly, come up where you're actually able to take losses from your rental property, because all the losses are typically used to offset the gain on sale. So it's really, while it's possible to happen, it's really not practical and not something you can really use to rely on to reduce your taxes. Excuse me. The second thing you could do is, if you earn less than $150,000 and you actively participate and own at least 10% of a property, then you can qualify for what's known as a special loss allowance. And a special loss allowance allows you to take up to $25,000, of rental losses against your active or non-passive income if you earn less than $100,000, right? But then it starts to phase out $1 for every $2 above $100,000. So, and then at $150,000, if you earn $150,000 or more, this is gone. The special loss allowance is vanished into thin air. You can't use it at all. But it also phases out $1 for every $2 above $100,000. So, for example, if you had $120,000 in income, well, you can only use the special loss allowance to take $15,000. So, unfortunately, for many people these days, this just isn't a viable option either anymore. So that leaves you with really number three, which is either qualifying as a qualifying as a real estate professional, also known as reps, or using the short-term rental loophole. These two strategies below can help you turn your losses from your rental properties non-passive. Now, qualifying as a real estate professional is typically going to be done for long-term rental properties, all right, not short-term. But the problem is qualifying as a real estate professional is you must spend 750 hours in a real property trade or business. And the second part is really what blocks a lot of people from using it. And you also must spend more than half of your total working time in a real property trade or business. So what does this all mean? This means that, sorry, people are messaging me where we're meeting. Unfortunately, I couldn't get this to post in the actual event, which is very frustrating, which is the technical difficulties that I was having. Facebook wouldn't let me do it, and Zoom wouldn't let me do it. So if anybody sees anybody asking about it in the event, if you don't mind posting this link or telling them to come over here, I would greatly appreciate it. But back to what I was saying. So this is what trips most people up. Because you have to spend more than half your total working time in a real property trader business, you cannot, most people, if you're working a full-time W-2 job or you're working full-time in a non-real property trader business, you cannot qualify as a real estate professional. And, that's because the IRS considers a full-time job to be 2,080 hours. And in order to work more than half your total working time in real estate, you need to work another 2,081 hours in that real property trader business. And it's just not possible, because that means you're working 81 hours a year, 81 hours a week, every week for the entire year. And the IRS knows it's not really feasible, and they will disallow your position. And in fact, we have over 500 tax court cases on the real estate professional status, the most litigated area of the tax code. And all but one case did someone be able to prove that they were able to do it. One case out of 500 was someone able to use the short-term rental loophole. So, the real estate professional status and have a full-time W-2 job. So for many people, the qualifying as a real estate professional just isn't feasible. It's just not. And I've consulted with over 100 clients, and I could tell you it's not feasible for a lot of people. So when you have the short-term rental loophole, that brings us to short-term rental loophole rather. And the good news is that this is the other way around Section 469. And the best part about it is that when you meet certain conditions, the short-term rental is not considered a rental activity anymore. It's accepted from that definition. And what that means is, and remember, all rental activities are passive by default. Okay. But not all business activities are passive by default. So when you meet certain conditions, the short-term rental loophole is no longer considered passive by default because it's no longer a rental activity, which makes it a regular trader business. And if you're able to materially participate in it, which you can do part-time, okay, we have plenty of clients, plenty of people here in the Tax Smart Investors Facebook group doing this part-time, you're able to turn your losses non-passive. All right. And it makes this really, really powerful. And the reason why it's called the short-term rental loophole, by the way, because I know some people always ask, is because these rules were designed in the 80s, again, back in 1986, for hotels. Okay. And back then, people Airbnb, VRBO didn't exist as it did today. So very rarely would you have a situation where people are going to be having an average stay of 7 days or less on a residential house, at least at the scale we do today, thanks to Airbnb and VRBO. And that's why it's a loophole. All right. Now, the problem with the short-term rental loophole is many CPAs, they don't understand it enough to give proper guidance to their clients. They just don't. We work with people all the time. Their CPAs have no clue how to use this. And I'm not just saying that to knock other CPAs. I wish more CPAs would know it. They don't. All right. And if you could try to piece this all together yourself, right? I mean, you could go on the forum, on our tax group, and learn that an average stay of 7 days or less is the key to is one of the keys to the short-term rental loophole. But the reality is there's a lot more to it than just that, right? And because this strategy is so lucrative, you want to make sure you're crossing all your T's and dotting all of your I's, because there's a lot of traps here that if you step into the wrong trap, you make the wrong move, you can blow the entire short-term rental loophole for you and perhaps even expose yourself to unnecessary audit risk. So what I did was, really what you need someone to break this all down for you. And, our firm has helped dozens of clients use this strategy to save 5 to 6 figures in taxes. We do it all the time. But the problem is the way we do this is through one-on-one tax planning. And one-on-one tax planning is expensive. And also because there's just not enough CPAs out there that understand this, we can't hire and train enough advisors to help everybody keep up. So, even if you did want to work with us today, again, it's expensive. You're talking about $4,500 to $10,000 plus. That's how much our clients pay us to work with us each year, right? On strategies like the short-term rental loophole. Even if you wanted to pay us that today, you wanted to come on board, we have a wait list out until October 2022, right? To work one-on-one with us on this strategy. So what I ended up doing is I created this short-term rental task course, which literally breaks down everything you need to know about the short-term rental loophole to save 5 to 6 figures in taxes in the shortest amount of time possible, right? I can't really break everything down in a 30-minute presentation or even a 60 or 90-minute presentation because there's a lot of stuff to do. And we're working with our private clients on this. We're doing this over a 2 to 3 week period, over 2 to 3 calls, sometimes more, with email support. We're going through a lot of extensive planning to help people use the short-term rental loophole. So that's the course. So what I did was, like I said, I broke it down to the course. And what we cover in the course is an overview of the short-term rental loophole and how to use it to save thousands. So I break down everything, the 7-day rule in detail, the 30-day rule. I break down all of that, break down how to materially participate in the short-term rental to reduce your taxes on your W-2 income. So I cover the material participation tests, what hours do and don't count. Believe it or not every hour that you could spend on a short-term rental property, such as like travel time, for example, counts, right? So you want to make sure you're counting the right time. You also want to make sure you're tracking your time. And I cover that as well, and how to track your time, how to really bulletproof your case, right? I also cover how to maximize your tax savings with cost segregation and bonus depreciation. I have references to cost segregation companies in there. People like Terry Judge, who was on this presentation. We have references to cost seg companies in there. We also have how to avoid critical mistakes that can cost you thousands in taxes, right? So I want you to bulletproof your case. I don't want you to spend too long at the property personally. I don't want you partnering up with people thinking you're going to go willy-nilly using this strategy. I don't want you placing the service at the very last second, not renting it out, thinking you're going to pull this one over. Like I said, I cover everything. And also during the first few weeks of the course, really what I'm doing is I'm answering all the comments in there, really making sure people understand this stuff. So if you want to use the short-term rental loophole, you're going to want to take advantage of it as soon as you can, because bonus depreciation phasing out in 2023, starting to phase out. So it's still going to be very powerful in 2023 and 2024 at 80 and 60%. And that's really what gives this strategy its punch, is that bonus depreciation. But after that, it starts to wane out. It doesn't become as powerful. So you really want to take advantage of this while you can. Now, I also have some bonus modules in there. I cover how to prove you materially participated to defend an audit. So that's time tracking. I have a bonus in there, a bonus interview in there, on how to maximize your tax benefits. I have a bunch of tools in there to help you implement the strategy, a time tracking tool. I have a cost segregation estimator tool. I have a whole bunch of other little things in there for you. And by the end of this course, if you take this course, you're going to know everything there is to know about the short-term loophole, everything. Okay. And I'm going to get into that in a second. And the reality is, like I said, our clients pay us $4,500 to $10,000 to work with us one-on-one in these strategies. And I spoke to a bunch of consultants. A consultant told me that I should not be charging with the type of tax savings that you can get. Again, 5 to 6 figures in taxes you could save using this strategy. The consultants told me that I shouldn't charge anything less than $2,000. That's what they told me. They said anything less than that, you're stupid. That's what they said. And I was like, no, we're not going to do that. We're not going to do that. I want to help as many people save money in taxes as possible using this. So what I'm doing is I'm giving away this course for only $247, right? If you save $2,500, if it's all you save was $2,500 using this strategy, that's 10x the amount you would pay for this course, 10x. And if you only saved $2,500, you did something wrong and you didn't follow what I told you in the course, because or you just didn't have that much tax to pay in the first place. You just didn't have that much tax to pay. So you only save a little bit, because most of the clients are saving $25,000, $50,000, $100,000 using this. So you're talking about 100, 200, 300 times the value of the cost of this course you're getting in tax savings. So for $247, it's really, really a no-brainer. And you can get it by going to courses.taxsmartinvestors.com. But if you're still here with me today, right now, right? If you're still here, if you made it through this course, made it through this presentation, or you're replaying it and skipping right to the end, then you can get $50 off by using the code Facebook, capital Facebook. It's Facebook in capital letters, by going to courses.taxsmartinvestors.com. Get $50 off, which means you're getting the course for only $197, which is $197, which is a real steal. Again, the consultants, and we spoke to somebody else too, and they told us that we were pretty foolish for only charging this amount. And I'm not just making this up. This is, they said that we should be charging $2,000, but no. So $247 is the price of the course. You get $50 off by using the code Facebook. Okay. And, if you're in there within the first few weeks of the course launched, I think last week, I want to be in there answering questions in the comments section, really making sure everybody has a thorough understanding of it, make sure everybody has clarity on what they need to do so they can use this to save 5 to 6 figures in taxes. And again, tonight, I didn't take any questions. Okay. You could go to the website, you could check it out. If you have questions about the course, feel free to shoot me a DM. Okay. Happy to answer any questions about the course, but it breaks down everything you need to know. And the next Facebook Live, I think I'm going to do an interactive one next Facebook Live, do some live Q&A. I'll do myths, short-term rental myths. Oh yeah, we cover short-term rental myths in the course. So all the things that you hear about on the internet, all the things you hear about on online forums or from CPAs who don't know what they're doing, I break all of that down in the course too. So I think I might do in a few weeks presentation on that. But what I'm definitely going to do is a Q&A at some point in this Facebook group on the short-term rental loophole. If you're still with me, again, you can use the code Facebook. I'm not going to go ahead and post that code in the chat box because I want people to actually watch the presentation to get it. But you can tell your friends if you want it. And want to thank you again for coming and being on the presentation with me tonight. And I'll see you on a future presentation or in the Facebook group answering some questions. So have a great night, and thanks again.